So if I started trading in 2025, what would I do? How would I learn? What would I learn? And what are the key things that I would actually do if I started from scratch today? I get this question quite a lot on all my social media platforms. People have just started trading. They don't know what to learn. They don't know the right path to go down. So as I've been trading for 6 years, I see people every day starting trading, the mistakes they're making. And also I made mistakes when I was learning to trade too. And that's completely normal. So you should learn from the mistakes I've made and watch this video, and hopefully you will know how to start trading in 2025. This video can also be useful for people that aren't straight beginners and they do have some knowledge in trading. Maybe you're looking to take your trading full time, or you're looking to become a part-time trader. There's also advice for that in this video. We're going to cover every single topic from mindset, technicals, growing your capital, and everything you need. So let's get started. So I have a diagram here and I'm going to go through each stage, but we're going to start with, what do you want from trading? This is a big question that you need to ask yourself before you start looking at learning. And I think that traders that are going full-time versus traders that are going part-time need to have different skill sets. Someone that is trading full-time, you need to have so much patience. As a trader that has limited trading hours, I'm only on the charts usually for 1 hour to 2 hours per day. And this means that out of a 24-hour period, let's say 8 of those hours I'm asleep, then the remainder of those 16 hours, you could say out of those 16 hours, 2 hours of trading, which means I have 14 hours where I'm not trading. So you have to force yourself to do things, to entertain yourself, to build discipline and patience, to not try and trade for those 14 hours. And that can be quite difficult for a lot of people. And if you want to become full-time, then that's something you need to work on. If you're someone that gets easily drawn in to what you want to do and you don't have that discipline, then trading might not be for you, or that's something you should work on before taking your trading full-time. So we're going to start with full-time trading, and we're going to zoom in here. Key point here, don't try to trade full-time without any backup funds. So when I say backup funds here, I mean an emergency fund. And as I say below, ideally 12 months plus. And the reason for this is, let's say you are planning on quitting a job, you're planning on going full-time for trading. And when I say full-time, I mean you're not trying to do anything else. You're not trying to run a part-time job or another business at the same time. We're talking about solely full-time trading as your only income. If you don't have at least 12 months of all your expenses saved up in an account, easily accessible, then you are going to feel the effects of trading full-time. And when I say the effects of trading full-time, I mean the pressures of trying to make profits every single month. People watching this video won't understand that pressure unless they're actually in that situation. Imagine you lose your job and you then have to pay rent, you have to buy food, you have to pay your electricity bill, your water bill, all of these things. And if you don't have at least 12 months saved up, you have to then force yourself to make that money every single month. And coming from a full-time trader here, if I was only trading and I didn't have money saved up, then it would be very, very difficult. And I don't know how a lot of people do it. You know, that's just what I'd say. People that do that and go full-time with no backup or emergency fund, I just don't know how they do it. So when I say emergency fund, I mean, let's say you have your monthly expenses. Let's use an example of $5,000. It's probably not going to be that high, but it's an easy round number. You're going to have at least $60,000 saved up, minimum. When I say minimum, I mean something could happen that you need to spend money on. That's obviously part of the emergency. You know, the emergency fund is called emergency for a reason. It's money that you should only have to go into if you have no other money. Your fridge could break, your car could break down, anything could happen that you need to spend money on. So you need to have funds that are available for that. And if you don't have this, stick to part-time trading. There's no point going in and saying, oh, I'm only going to make good money if I'm a full-time trader. This is not entirely true. There are loads of part-time traders that also run businesses, or they do other things on the side that are still making great money from trading. You might make less money by going full-time because of the pressures you're putting on yourself. So maybe by having a part-time job and having an income that covers your expenses will actually make it easier for you to trade full time in the future. So maybe that is something that you could consider. And it'll also keep you busy as well. A part-time job will keep you busy. You won't be checking your phone every 5 seconds like you would be if you were at home. And yeah, it can improve your trading massively. I would obviously suggest more than 12 months because we all know trading doesn't just happen in 1 year. And if you're going to try and trade full time, you shouldn't follow what I did and just go straight into it at 16. You should go down the route of getting to a stage where you are a profitable trader first and then go full time once you had that money saved up and a good plan on how you're actually going to manage your finances. So moving on to how to actually go full time and what to do when you are full time, you're going to want to focus on growing your capital and not your profits. And this is what people don't really understand. If you're trying to make $5,000 per month and you have $50,000 you're trading with, this could be your real money or it could be a prop firm, whatever you're trading with, you're going to have to make 10% every single month. Whereas let's say you just increase your capital to 200k to make 5k per month, is 4 times less effort. You're going to have to take less trades, you're going to have to make less profit to make the same amount of profit. So when I say focusing on capital, not the profits, if you increase your capital to 400k, 500k, $1 million or whatever you can actually expand it to, it will make it so much easier to make that 2% or that 1% profit per month that you need to just live. Anything more is a bonus, obviously. And let's say making 2% per month can set you up for life if the capital is large enough. This is something that I preach about on YouTube, on Twitter, on Instagram, and people disagree massively. I didn't think it was as controversial as people seem to take it because the way I see it, you shouldn't have to try and push for 10%, 20% per month. If your capital is large enough, 2% per month can basically set you up for life. You'll be in the top 1% of earners in your country and you'll just be living a good life. And you don't want to push it too far that you're over risking, you're taking trades you wouldn't want to take to target an amount that is kind of unrealistic. I often bring up the example of a compound interest calculator. Obviously it's not super accurate and you could say that, oh, well, that has to be every month for a certain percentage. And if you're compounding the exact amount, that is true. But it does give you a good idea of the claims that people are aiming for. If you're aiming for 10% per month consistently, starting with $100,000, after 5 years, you'll be making $30 million. Does that seem realistic? It doesn't seem very realistic to me. And you only see the top traders actually making those returns. You won't see hedge funds making those returns. And do you know why? Because they risk less to actually make lower returns because their capital is so large. If a hedge fund is making 10% per year, that is probably billions of dollars. So you're comparing that on your $1,000 or $10,000 account, it's just not really the same. But if you can scale up to 500k or $1 million in capital, I'm not saying this is just personal, by the way. As you see here, we have prop firms too, because getting up to that personal capital is very, very difficult. And most people won't ever be able to do that, but it's definitely possible with prop firms. You can then make 2% per month and you're making $20,000 per month, which if you then use that, as we say here, to compound a personal account alongside, you're then making even more money. If you're putting, let's say 50% of your profits, or it could be 25% of your profits withdrawn from a prop firm into a personal account and compounding that, just from the compounding growth, your account's going to be growing at $5,000 per month. That means your account balance grows by 60k per year. And it'll obviously grow more if you're profitable. I see a lot of traders that are trading prop firms and they claim to be profitable traders, but then they don't trade a personal account. If you're not trading a personal account, you're basically telling yourself that you're not a profitable trader. Why would you not use your profits to make more profits? It doesn't make sense. So that is kind of the route I would go down as a full-time trader. Don't try and trade full-time. Make sure you have hobbies and things to do that is allowing you to spend time away from the charts without being hyper-focused on it. And that will give you, good distractions from entering trades. So we're going to move on to side income now. And this is for the person that either has a part-time job or they are maybe in a full-time job and they just want to make a side income. So the key point here is to learn around the times that you can trade. So I have 2 examples here that I've written down, so we'll go through those. Let's start with the morning trader. So I'm going to go off UK times here because that's what I have experience with, and most of the people watching my videos are from the United Kingdom. So let's say you have to work at 9 a.m. You can trade late Tokyo or early London session. My strategy is based off what happens late Tokyo and early London. So I could probably trade and set alerts or limits before I even go to work if I had a full-time job. So this means that if you do your analysis before you work and you maybe set a limit before you work, you can get your trading done. But the only way to actually guarantee this works, or works as well as possible, is to test the times that you can trade. I see so many traders test full London session or full New York session when they can't be on the charts during those times. So their test results are really, really positive. They're making loads of profits. They go in the live markets and they're not making profits, and they're confused why this is happening. The main reason is they're not able to capitalize on the trades they're actually presenting because they're not on the charts. They can't be focused at that time, and as a result, they're not able to capitalize on the profits. So if I was only able to trade from, let's say, 7 a.m. to 8:30, I would only have my trading at that time in my testing. I would have an indicator that says, here is the opening of my allowed session and here is the closing time. If price is out of that, do not enter the trade. Or maybe you could set a limit at 7:30 or 8:30, whenever is the latest you can trade, and then see how price goes if you set limits. Maybe you're better at executing before 8:30, maybe you are better at setting limits that hit after 8:30. This is something you can test if you are looking to trade in the mornings before work. Or you could do what the evening trader could possibly do. You could do these both the same way, but if you're trading in the UK, you can kind of get the volatility from London session if you are able to trade before work. That's why I say as an evening trader, it's better on the high time frames or swing trading. The reason for this is that I feel like if you get home from work, it's easier to then go on the higher time frames and do your analysis for the next few days. I've seen a lot of people improve their trading from increasing their time frame. So from going from the 15-minute to the 4-hour, or the 4-hour to the daily, and because they have limited chart time, they're not really missing out on much that's going on. So they're able to fully backtest their strategy. They're able to set limits for trades that might hit the limit in 2 days, and they're not missing out on the moves. And this will work perfectly if you have time in the evening or even in the morning. And I just put it down as evening trader so we can separate these two different styles. So you do your analysis before you sleep and you set limits. It could be limits or alerts. Limits are obviously better because if you set an alert, you then have to be able to get up the charts, calculate your lot size, set the trade and everything at that exact time. Whereas a limit, if the trade is valid, price will tag into that limit and go into the trade. The best way to actually test this for, seeing if it's profitable is if you're unable to check the charts when you're actually working, the best thing you can do is basically test a set and forget strategy. So you enter a trade or you set a limit and you just let it run. And maybe you can do management at the times you're on the charts. So let's say your trade hits at 12 p.m. and you notice at 7 p.m. when you're usually at home able to analyze the charts, the price is no longer valid. You can test closing at that time. But don't test closing positions early or taking profits early if you're not able to be on the charts at those times, because the results will just be very, very different from your live results. That's something that people don't really focus on. So that's part-time and full-time traders, what I would actually do. So now we're going to move on to how I would actually learn to trade. And the key point here is what to learn. So we're going to firstly go through the mindset. So we'll go through the mindset first. And here we have prepare for the long game. When I say prepare for the long game, I don't mean focus now and like you do in index fund investing and just put money in an account and just buy and hold, long positions or, things like that. I'm not saying do it that. I'm saying focus on the next 3 years, the next 5 years, the next 10 years in your trading career. Don't just focus on this week or today even. I see a lot of people, they DM me and they send me their trade results and I'm like, why have you taken 17 trades today? It's like it's your last day trading and you have to capitalize on any movement in the markets. The traders that take the most trades usually are the least profitable. Firstly, commissions are going to add up massively. Secondly, you can't have that many valid setups in a day, in my opinion. It could be different for your strategy watching this, but that's just how I see trading and what I've seen. Profitable traders aren't usually doing that. So preparing for the long game means that If you're focusing on growing your account over the next 3 years or 5 years or even 10 years, that'd be even better, then that is the ultimate goal. Preparing yourself to make profit long term is all you can do as a trader. So many traders think they're doing really well, they scale up, try and make tons of profit, and then they're no longer trading in 2 years' time. How many traders do you see online claim to be making it big, and then in 3 years, they're ghost, no longer trading because they didn't focus on the long game? I'm focusing on the long game. I don't need to make millions and millions of pounds right this week. Obviously, it'd be great. I'm not forcing myself to make less profits, but it would be nicer if I could slowly scale up. And I feel like you develop as a trader rather than going fully in the deep end at the start of your career. And by doing this, you need to accept that you will lose. Accepting that you will lose is very, very key. And I feel like it's one of the most important factors of becoming a trader. If you cannot accept that you will be wrong sometimes, you will lose money long term. What does it mean by accepting that you'll lose? Well, I go into a trade, I've calculated my lot size, I've calculated my risk. I now know if I press enter, if I press buy, if I press sell, that there is a chance that this trade loses. And I have to accept that when I enter the trade. And by accepting that, I know exactly how much I'll lose. And that is a worst case scenario. Worst case scenario if you enter a trade is it loses. Obviously. So if I've accepted that the worst case scenario is I'll lose 1% of my account. And I've accepted that, that's fine. But the people that don't accept that, they will move their stop loss. They'll hold the trade if it's no longer valid because they don't want to lose the trade or they don't want to miss out on their profits. A lot of these things actually happen. But accepting that you will lose kind of means I'm okay with losing. I don't care if I lose this week. If I lose this month, it's fine because that's trading. I'm not going to win every single week. I'm not going to win every single trade. And accepting that you will lose is kind of part of this. The traders that can't accept that they will lose will never win. And like I said on the point below, learn to learn from mistakes and wins. So when I say learn to learn, I mean you need to have a system in place where you can learn from your losses and your wins. And by teaching yourself how to improve, you're going to improve if you win or if you lose. The best way to improve if you lose is to focus on the mistakes you're making in your mind. The majority of mistakes traders make aren't with their strategy, but they're with their mindset towards the markets when they are in trades. So this could be FOMOing into a position, and FOMO obviously means fear of missing out. They don't want to miss out on the trade when they could see that price is going to drop further, and they just get in the trade. Even if that trade wins, you need to learn from that mistake. Making a mistake and winning is the worst thing that can happen to a trader because they get rewarded for breaking their plan. If you get rewarded for something that if you do something wrong and then you get rewarded for it, then it makes it seem like it's okay in your head. So the next time that actually happens and you had the opportunity to make the same mistake, you will probably do it because you got rewarded for it last time and you made profit. But if you're properly journaling your positions, noting down how you feel during the trades, why did you make that decision? Why did you break your plan? Why did you not follow your rules to perfection? Even though the trade won, then you can learn and improve for next time. But if you're not doing that, then you're just going to be stuck in the same place and wondering why you're not improving. It's just an endless cycle of just make profit, make a mistake, make profit, make a mistake. And then you'll lose loads of money because you didn't follow up on the mistakes you made when you won. So learn from your wins and your losses, especially your mistakes from your losses, if there are any, and the mistakes from your wins, if there are any. So let's move on to the technicals. And we're going to start with a key point here, risk management. Beginners don't like to hear this word risk management because they want to make as much money as possible, but focusing on protecting your downside is your number one priority. And if you do this from day one, you will be 100 times better a trader as you would have been if you didn't focus on risk management from day one. And when I say protecting your downside, I mean, if you look at someone, a hedge fund, and ask them what their number one rule is, and it's not lose money. If you don't lose money and you limit your losses, then the only way you can go is up. If you're able to protect your downside, meaning covering your risk or basically reducing your losing streaks or losing smaller every single time, then you were able to protect your downside. And then when you do win, and you win a normal size, you were able to win big. And that's the kind of the whole point of risk management. Lose smaller and lose less than you win. If those two things are apparent, then you are going to have a profitable strategy and you're going to be a profitable trader. And those are things you need to focus on. If you don't focus on risk management from day one and protecting your downside, then you won't be a trader. The best way to put it is, if you have an account that has a 50% drawdown in a year and you only make 30% profit, you could say, oh, I made 30% profit. It's a good year. But you had a 50% drawdown. So it's not a good year. And that's not a good strategy. Whereas if you had a 3% drawdown, but then you made 10% in a year, that is a very, very good strategy, because you can multiply that by 3. You then have a 9% max drawdown and a 30% return. So although it seems lower, by protecting your downside and basically reducing your overall max drawdown, you're then able to scale up to a drawdown you're comfortable actually risking and being in, to then triple your overall return. Something to consider for you guys watching. So technicals, and how do you learn technicals? First protocol, you could be to buy a course. And obviously I'm going to say that my course is the best, the link trading mentorship. As you see down here, we have everything you need. We have all the sections. We have a Discord community. I go through all my back testing, and you can see the payouts from all the people in the group. Some even have over $100,000 paid out from certain firms. So I obviously have had many payouts with very, very different firms. We've got solid firms like FTMO, we've got E8, we've got True Forex funds, which are no longer around. We've got Aqua Funded. So I've been basically paid out by every single firm in the industry, mainly to show that I can do it on every single firm. It's not a fluke that I get a one-off payout. And some firms have even had $100,000 paid out. So if you are looking to join, then you can check out the link in the description and join the mentorship. You can press join now and it takes you to the checkout page, and you can check out to the course. And the main benefits of a course, everything is in one place. So if you're learning from me or you're learning from anyone else that has a course, you're going to be learning everything in one place. So you go on that course website and you see everything from risk management, backtesting, creating a trading plan, the confluences you need, the trade examples, basically everything you need to know to actually learn and build a strategy. And in my opinion, learning one strategy and sticking to it is the best. Let's say you learn a strategy now, you buy my course, for example. We'll use that as an example because it's probably the best example I can give. And after a month, you don't feel like you're doing as well as you could be. Jump onto another strategy and spend another month there and realize, oh, this one's the same. No. Do you think that you can learn after a month something completely new that has taken me years to build and develop? Probably not. You're not going to be profitable and making tens of thousands of dollars within 1 month. Yes, it is possible, but is it likely? Of course not. So learning to stick to one strategy is the best kind of idea that you could possibly have. Develop it to fit to your style. I trade in London session. You might be from America, so you have to trade in New York session. So you can tailor the timings that I trade to the New York session and trade it slightly differently, because your backtested results are going to be different from mine. Your psychological decisions are going to be different from mine. So it's not going to be exactly the same as the trades I take, but a lot of people in the group do seem to take the exact same trades as me. So it is kind of working in that respect, but sticking to everything in one place with one course is kind of the best thing you can do in my opinion. So how do you learn kind of by yourself? Well, you can backtest patterns you see. So let's say you see that on a Monday, that price retests the low of Friday or something like that. Then you can backtest that and build up a data set that says, okay, this amount of times Monday is retested from the Friday low, those sort of things. And then once you have a data on that, you can say 80% of the time Monday retests the Friday low. Okay, how can I get an entry from this? And then you start to add different layers. Okay, now we have a break of structure in Monday London session. I can get in and target the Friday low. Just simple things like this. I'm not saying that's a strategy you can use. That was just a random example, but that is how I would build something from scratch and kind of add it to my testing pile. I'm always testing different things. And the main reason for this is if I can add something into my strategy or add another strategy into my portfolio that makes an extra 5% or 10% per year with very, very little work in actual trading that doesn't take away time from my main strategy, then that would be great. Currently, I'm testing that New York breakout strategy that I'm testing on my second channel. You can check it out Will Aldridge is the name of the channel. I'm doing weekly backtesting videos on there, building a strategy from scratch. And that takes probably, I think the trading window is 2 hours. So 2 hours out of my day, maximum. Usually the trades are within the first half an hour. But if I can add 30 minutes per day over the year, and I'm adding an extra 10% or 20% profit, that would be absolutely amazing. And it also kind of means that if I lose in the morning and I win in the afternoon for my New York, then I can be profitable in the day. So I'm kind of diversifying my trading. And what I like to do is double down on what works. So if I have something that I can see is working well, I'm not just going to then see, okay, it's working well. Yeah, I'm just going to go test something else now because that clearly works. No, I'm going to double down and try and make that one thing as profitable as I can possibly make it. But you need to be careful to not make the mistake of curve fitting. And curve fitting, kind of summed up here by testing different market conditions, is let's say you've backtested a year of data. That year of data might be just a trending market for a year. And you're now testing and have the data for a year. Let's say it's 100 trades. You're going to then adapt your risk. You're going to adapt what an A+ setup is based on that one market condition. And this is called curve fitting. So you're making it perfect for that one trading period. So for that 2024 year, your strategy could be perfect based on what you tested. But let's say you go into 2025, we have different conditions. We have obviously Trump being president. We have tariffs. We have loads of things going on. Your strategy might be absolutely terrible because you haven't tested it in volatile conditions. You haven't tested it in a consolidating market. You haven't tested it if something happens to the dollar or, random things happen. You need to test random points in time. So you could test 3 months in 2022. You could then test a consolidating market in 2020 or a trending market in 2020 because we had the random COVID lockdowns. These things you can actually test. But just testing a small data set and just going, okay, I'm going to make it perfect for this small amount of data, that's curve fitting, and you don't want to do that. So as you'll see from the backtesting series I'm actually doing, I'm first testing a year, but I'm not going to only adapt that strategy from that 1 year of data. No, I'm going to see what happens. Did I perform well when it's consolidating over that year? Then I can go and test different consolidation periods and see, okay, is it working as well here? And so many people think that 1 year of data is enough. It is definitely not. If you traded just 2020, you basically just had, if you're trading gold, it just went up. If you had a strategy that just bought at the start of the year and sold at the end of the year, you probably would have made tons of profit. But if you try to do that in other years where gold didn't go up all year, then it probably would have been a terrible strategy. So if your strategy was making loads of money on longs in 2020, and then you said, oh, I'm not going to short anymore because I only win on longs, you then think, okay, you go into a year where gold doesn't just long, and then it doesn't really work because price is also going up and down, which you need to know. So this is kind of the path I would take for different stages of traders, how I would learn and what I would do if I was starting from day one. So if you have any questions about this, be sure to comment them down below. Join the mentorship, and I'll catch you guys in the next video, hopefully when you've started taking some steps towards being a profitable trader.